Welcome to the Startup Grind.
Good morning, everyone. Nice to have you here and have a chance to talk to you a little bit about some things that I think you might find to be fairly useful. That's the idea. If not today, certainly tomorrow, next year, the year after. But this is something that you really do need to get some awareness about as an entrepreneur, as a business owner, as someone who's interested in pursuing innovation or developing an idea, a concept, and taking it to the marketplace. And so what we're going to talk about then today is something in my world. I've been involved in tax incentives and credits now for nearly 20 years, and it's something I gravitated to. As Rich mentioned, I practice as an attorney, as a CPA. This is something that I found passion for, and because it really does make a difference. This isn't just financial statements and doing a tax return. This is actually helping people develop their ideas and go to market with their ideas, and to constantly improve on those. And so that's where I'd like to start, is the idea that this is, yes, we're going to talk a little bit about taxation, but it's mostly going to talk about policy. Why, how, and what. And so with that, I will continue the conversation. There we go. Okay. So you might think, as a startup, as an early stage company, as a founder, why am I even spending 10 minutes thinking about or talking about taxes? Well, maybe that was historically the case. Today, it's much different. Much different in that our tax policy does support actively the startup community. And this is something that has been evolving for maybe about 40 years and to where we are today, which is about the best I've seen bundle of opportunities available to startups and early stage businesses. The five that we're going to talk about today briefly, but as part of our workshopping, we'll look at some words and numbers. In other words, we're going to talk about the employee retention credits and how that might help your business, even as a startup. We'll talk about research and development tax credits. That's something that is more widely available than you might think. And then we'll talk about a few of the more esoteric things that might be special areas that you're interested in or your business is in, and we'll spend a little bit of time on that because these are more down the road. But still, what this group of incentives and credits have in common is that every one of these is available to a company that is pre-tax, meaning you may be spending money and you might have some sales, but you're not making money, you're not paying tax, obviously. All five of these are available to you even as a pre-tax company. Even better, take it to the next level. All five of these are also available to you as a pre-revenue company in certain circumstances. And so that should be interesting to you as a startup, as an early stage company. And again, this is a companion or first cousin of the grants and resources we have. Other folks are specializing in grants and pursuing funds from government agencies, foundations, and such for an early stage company. Those don't just end there. Those go through the life cycle of a company. This is a companion to that, in that this is now you're preparing to be an operating company, and you'll be filing tax returns. The one thing that I would say on the first two that we'll talk about, it will be important to have people working for you, because that's how you'll generate the base for claiming the tax opportunities and incentives. So a couple things about tax to set the table before we proceed. Taxation and paying and receiving refunds and such, claims, incentives, credits, it's the execution of tax policy. These policy decisions have been made elsewhere. Congress will pass laws, president signs them, And then we have tax policy in deployment, and that's where we are with all 5 of these areas. Employee retention credits is part of the CARES program that was to help get us out of the pandemic. R&D tax credits started in 1981 with the shift from a mindset of demand to supply economics. How that has worked out, it's still out for discussion, and that's where we have the constant Congress play relating to how much of incentivization should we be providing to private sector versus how much should we pull back and let the private sector figure these things out themselves. We're in the middle ground there, and that's probably where we'll be for the foreseeable future. Energy investment tax credits started early, but now they've taken new focus with our movement toward renewables. Same with advanced energy projects and advanced manufacturing around semiconductors. All public policy driven. With that, let's talk briefly about the employee retention credit. This was part of the COVID relief package in CARES in 2020 rather. And in that package, there are several ways to qualify for these benefits. One would be safe harbor, and this is the primary. This would be if your gross receipts dropped below a certain amount from the base quarters in 2019. So you'll compare 2020 and 2021 quarters to 2019 quarters. The last normalized year is how this formula was derived. So that you may have been in existence in 2019 and you'd have that information. What if you were not? What if you're a startup? You get special treatment. If you're a recovery startup, that would be a company formed after February 15th, 2020. You automatically qualify for 2 quarters of these benefits, up to a maximum of $50,000 per quarter. Now, this is important to understand. You have to have W-2 employees, and these cannot be by a majority owner. You can have 50-50 owners as long as it's not a majority owner. And the 50-50 owners are not related. You can qualify as a recovery startup, and that's based on your payroll. And now we'll show a little bit on how to now get to some actual scenario of what this looks like in dollars. So in this situation, we'll look at a recovery startup. Might have started in 2020, July 1st, say, in this example. No money was raised. There was no capital available for payroll. Self-funded, bootstrap, no W-2 employees. ERC for that year would be 0. If the company existed in 2019 and had some 2020 payroll.
What does the ERC mean?
Employee retention credit.
Okay.
Yes, this is that program that is part of that tax act in the CARES Act. And so the employee retention credit, that's the focus on W-2 employees, is for that reason. It was to encourage companies to keep people working. So in this case, we've got a startup. It began in July of 2020, no W-2, so no ERC for that year. Now, 2021, we're looking at a company that now receives $100,000 seed investment sometime in 2021, probably toward the end of the second quarter, because the first things that are done typically when funding occurs is employment is incurred, and that it could be either the founder, likely the founder, and maybe a technical person or two. So at this point now, you've got that $100,000 in seed capital, and you're set up to pay yourself and your partner, 2 partners, 50-50, say in this example, $10,000 per quarter each. So now that those 2 folks are getting paid $10,000 from their seed capital so that they can continue pursuing developing their business opportunity. And so those 2 folks getting that $10,000 per quarter will now qualify the company for employee retention credit for that quarter. So they've had some success. developed their concept. They're at a point now where they need help. They've got to get some potential, maybe some software developers. They'll hire a couple more people. So now they've hired 2 additional people, Q4. So if they hired these people in October, that's the beginning of the Q4 of 21. Now they've got a payroll of $10,000 per quarter for 4 people. So now they have $40,000 payroll for that quarter versus $20,000 payroll for the third quarter. Here's what that looks like. For Q3 2021, that $10,000 paid to each of the 2 50/50 owners who are unrelated would generate an ERC, an employee retention credit of $7,000 each. That $14,000 would then be claimed in a amended tax return and received by check. Then fast forward to Q4. Remember, we still have the 2 founders getting their $10,000 per quarter, and we have 2 new employees doing R&D and other functions. That's another $7,000 for each of those in ERC for that quarter. So now the ERC has doubled for Q4 2021 to $28,000. Total of $42,000 in ERC, employee retention credits, from this benefit for this startup, who is, in this case, both pre-revenue and pre-tax. And so now what this company has done, they're $100,000, they've spent $60,000, they're getting $42,000 back. This is extending the runway. This is smart use of your investors' money. Important to note, this is not expired. The program expired the end of 2021. However, you still have up until April 15th of 2025 to claim those ERC credits you may have from the third and fourth quarter of 2021. So recovery startups, any startup involved in that has done some hiring in 2020, 2021 needs to look at this to see if there's this available incentive, available credit for them. And again, this is to extend your runway.
They're literally getting, in this example here, they're literally getting 42,000 back.
Yes.
Wow. Okay.
And it's a multiplier based on how many employees there are who are W-2 employees earning that maximum of $10,000. I set this example up at the maximum. You're allowed $10,000 per employee per quarter for those 2 quarters at 70%. It's just the way the math works.
Okay.
And so, yes, if you've got 10 employees, and there are many companies that they might be at that next stage of startup where they might now have some angel funding, where their payroll could be 3 or 4x that number. You can multiply that 7,000 per employee 3 or 4x.
So what years is this covered?
This started in 2020, in March of 2020, first quarter of 2020. This was out of the CARES Act, which was to address the pandemic.
Right.
And so this was one benefit that was available to companies who had W-2 employees.
What's the end date?
The end date was, for most businesses, it was third quarter 2021,
Okay.
because this does go back to 2020 for other than the recovery startup, which is a startup that was founded after February 15th, 2020. And so for recovery startups, you can also claim fourth quarter 2021. And so that's a big benefit of being a startup that other companies do not have. And so this is a 2-quarter benefit for a recovery startup. If it's a startup that started before 2020, sometime in 2019, there's a potential to go back for even more from 2020. Using this example is just to address that startup that began during COVID.
Okay.
And again, this is available up until April 15, 2025. Of course, filing earlier is better. A couple of reasons for that. One is IRS has been backed up, and so claims have been taking a long time to process. But the other is losing records and the idea that just forgetting about it, not getting it done, time, you get busy. And so earlier is better because you're monetizing it better too. So you've got time value of money, especially time like this with increasing interest rates. You might find that it's very helpful and very useful to get this cash in hand sooner than later. Okay, let's talk a little bit now about R&D tax credits. This is really the driver here with startups, early stage businesses, especially technology companies, but not all companies are technology companies. We heard from June earlier today. She's actually, believe it or not, a technology company to some extent. And many companies are like that, Rich, as you know, with apps being built and designed for all kinds of purposes and functions. Now bringing in AI functions with these assistants and through the chat GPT. This is all evolving, developing, but essentially any business that's involved in some sort of technology development might have an R&D credit tax potential. Originally, this was for science-oriented companies, the semiconductors, the life sciences type companies, back when it started in 1981. And again, that's evolved to where today it's really commercialization is the goal. If you're commercializing a product, if you're developing something, improving it, you may qualify for an R&D tax credit. So the factors you look at, if you look at column 1, first column, qualified expenditures, if you're doing some of these types of activities, we would evaluate your wages, supplies, and any prototype expenses in developing or purchasing. Also, U.S. contractors. You might be using software developers. As long as they're U.S. based, we can take 65% of that. You also may be using leased computing, and this is the case if you are doing something in the cloud where you're doing an app, for instance, and it's going to be cloud-based. Your early R&D is going to be in the cloud, and so some of those costs, most of those costs may be qualified. And so that is at least those are the elements that go into your qualified expenditures. Does not include things like funded research. If you have an SBIR grant, for instance, there you may own the IP, but you don't really have any risk. That's the definition of funded research. You must have the economic risk of failure, and you must be able to retain at least a substantial amount of the IP. So SBIRs typically do not have the risk aspect. No aesthetic or look and feel type activities. This is going to be something oriented to science, hard sciences, something engineering, something of that nature. No management techniques or time studies, even though that essentially is part of your R&D. Even marketing is part of your R&D. Those kind of things are excluded from the R&D tax credit.
What about like clinical studies? Is that
clinical studies can qualify? Yes, if it's towards certification and it's essentially part of proving out the material, proving out whatever you've developed. It can be part of your R&D costs.
Would developing IP like paying for like patent fees, is that part of it, or is that
patents are a bit different? You can expense your patent costs. For R&D, it's been a bit more up in the air. It's the idea if you're buying patents, you're not going to qualify to be able to include it in your R&D credit, nor can you expense it necessarily as an R&D expense. But if you're developing a patent, your time, your all of that can go into it. All of the materials you use, the bench research, of course. The question has been whether attorneys' fees and the prosecution of a patent can be included. It can be expensed. There are positions, both sides of that, on whether it's includable in the R&D. I look at the nature of the work, and generally, I do see, in most cases, be able to include patent costs, developed patent costs in the R&D. There are some cases that
if I'm paying
support
somebody to work on a patent, an employee, that his wage would be
That's a great question, because that's literally what happens in many large corporations. They're working, they're dual purpose. They might be doing bench research that is supporting the patent prosecution. And so that's more of an easy case. The ones that are more difficult is if it's just patent prosecution. There are some old rulings that disallow the patent prosecution costs, attorney's fees and such. There's a case that does open the door to potentially including them. And so that's why I look at it case by case.
So I'm working with a physician that actually has a couple of patents,
Mhm.
and he's put a lot of time into it. Can his time, I don't know if he's paying himself, but
Right.
would his time be something that could be in this expenditure?
But potentially, and here's how that gets a little, if it's a side business that he drops down and it's a separate, let's say it's a small corporation, a business that he sets up a small C corporation just to do that, he's not paying himself. So he's not incurring costs.
Right.
So you can't quantify the research. However, if he's doing it as part of his general practice, maybe 10% of his time from that general practice could be allocated to his R&D activities, but now you've got to bring in his entire practice. It's more complex. It's usually best when you have something like that or see something like that to drop it down once it has some form, and then possibly try and fund it somehow, and then generate some costs either with third parties who are assisting you, or materials you may need to buy, or costs you need to incur. If you're able to do that, and there isn't a control issue where this physician brings in other partners, for instance, then that can usually be classified as a standalone R&D activity that can generate R&D credits early on. And as we'll see in a minute, that might even generate some R&D credits, even pre-revenue and pre-tax, obviously.
Okay.
So that's a good example, good question. So the things you look at in the R&D credit is there are some elements that we look at. We're not going to really spend time on that, but what I'd like to do, actually, let me just briefly do this. 4-part test in the middle. This is really the driver of whether you're performing R&D or not. And first of all, you've got to be developing a new product, process, improving performance, or a component, something of that nature, something new that you're intending to commercialize. Then it needs to involve the discovery of information that is technological in nature. You're trying to learn things about the process that you're developing, that you're the product you're trying to go to market with. You've got technological challenges, and you're trying to resolve those challenges through a process of experimentation, iteration, the what ifs, the experimental lab bench work, the hard technical work you do to see if your product or your component or your process will be successful. And again, this is not a marketing focus. This is a technical focus, whether it's a functional possibility. And then when you get to that point, you may have something that you can claim an R&D credit for. You do not have to be successful. You can fail. Failed attempts at developing a new product, process, performance, or component is best evidence of R&D, because obviously you would not have spent the resources on the pursuits if you had believed or felt that it would have been successful. And again, just to round this out, you'll be typically applying hard sciences such as engineering, biology, computer science to your discovery functions, activities. Now we've got the industries where you see this. Again, as I said earlier, typically this was computer industry, life sciences, things of that nature, where engineering, where you were finding R&D credits. Today, it's much more broad. Obviously, architecture, construction, engineering are using a lot of iteration and using a lot of hard science to develop new concepts, products, processes, life sciences and healthcare constantly cycling through the R&D process. It's a lifeblood of those activities. Energy and clean tech getting more prominence today through other incentives and credits, but again, very important supplemental raise, if you will, for the energy and clean tech industries. Agriculture, again, same. You can see the life science applications in agriculture, aeronautics, aerospace, AI, robotics, transportation, software engineering, manufacturing, and production. All of these areas are much broader than the initial R&D credits that came into existence 40 years ago. And so if you're doing some development activity using the hard sciences in some way, you're likely doing some sort of R&D, especially, again, new product, new process, improved product, improved process. Those are the things to look at. Okay, another example here now. Let's take our earlier example and okay, let's take our earlier example now and we'll go to the next place with it. So our two partners, 50-50 partners, got together and they had an idea. They wanted to develop a drone and they wanted to manufacture these drones. And they convinced some folks to get on board with them, and they paid themselves for that first year. For the second year in business. The first year, they didn't pay themselves anything. That was 2020. That was their developmental bootstrap year. 2021, they got their first investment from likely a very close person to them, either their own capital or a family member or a business associate who's interested in this area. And so they've gotten that first money, and they've used that first money to prove some basic concept to now where they've got something that they were able to present and get funded by a more formal type of capital. And this would be your angel level capital. Let's say these folks who got the 100 of that startup seed money, now they've gotten another 300 from angels. Total capitalization of 400,000 at this point. And let's say now in year 3, 2022, they've got a bigger payroll, and of that payroll, $180,000 of it are performing qualified services, the things we just talked about, the types of activities needed to be able to claim an R&D tax credit. They're also buying supplies. They're buying prototype support. They're maybe developing and they're needing to buy components to make their own prototypes. And in some that can be costly, especially in a technical area. They were also using outside contractors. Maybe they've got some designers, some software developers, people who are providing services beyond what they're able to pay for payroll, in their payroll. And so they've got another source of R&D spend, qualified spend, and that would be through contractors. They're also working in the cloud because that's how their drone fleets that they're envisioning will need to be controlled. Obviously, this will be a cloud-based application and platform. And so when you look at that, that's now they've spent $260,000 in 2022 of the new 300,000, say. So the way the R&D credit works for a startup, for an early stage company, is you take half of your qualified spend. You've got a base, a credit base. In this case, it's 130,000. You take your R&D credit rate. This is your federal rate. There is a state credit in California, but it's typically not going to be available in any way because at this point, because you're going to be running NOL, you're not going to be generating any taxable income yet. But your federal credit rate is 20%, and so that generates a $26,000 R&D tax credit. So, well, great. Didn't you just say that we're not running any tax liability yet. What are we going to do with that? Well, here's another key incentive available to startups that are pre-tax and even pre-revenue. This is called the payroll tax offset. And so the way that works is this $26,000, because you've got employees, you can claim that $26,000 against your payroll taxes, your FICA, your employer share of FICA that you have to pay. And so now from this $260,000 in qualified spend, you're getting 10% of that back. You're churning 10% of your investors' money. That's, again, extending your runway. That's the idea here. So when you take now that into account, here it is. We've got $400,000 invested, $100,000 seed money in year 2, $300,000 our angel round in year 3. Of our $400,000, we've been able to supplement it now with $14,000 plus $28,000 from 2021 employee retention credit. That's $42,000. We're adding another $26,000 to that. Now we have $68,000 of fresh capital on top of the $400,000. I'll go one more. I didn't use an example. I didn't give an example here because I wanted to illustrate, and we'll just backfill and make assumptions. In year 2, there were wages spent. There were costs incurred. There was R&D in year 2. It wasn't as big as year 3 or as big as year 4 and 5 maybe, but it is something. And I would estimate that was probably another $12,000 in R&D credits for year 2. From that was from the $100,000 plus the $40,000 that was recycled. So now you're looking at about $80,000 in reclaimed funds of the $400,000 that you were able to raise. You've now extended your runway 20% as a pre-tax, pre-revenue startup. You've added $80,000 to your $400,000 investment. So your investors are going to be looking at your financials. They're going to be involved in your management. They're going to be active. And they're going to want to know where that $80,000 came from. How did you do this without revenues? And this is something that will likely they will see you're a savvy, investable, bankable partner. And this is the kind of thing that separates you from other startups, perhaps. And these do not go away just because you're a startup. They actually can increase and improve and get better as you grow. This is an example from a client I actually did perform this work for. By year 4 and year 5, they were maxing out this R&D tax credit, which is at the time $250,000 a year that they're able to claim against FICA and get a refund for. That was the maximum. Today it's $500,000. And again, as I said earlier, tax policy did not support and incentivize startups many years ago. It was a different view. Innovation was not seen the same way, perhaps. It was large corporations that received most of the benefits and incentives. That has evolved and changed dramatically to now where we're funding and providing resources to our startups, our early stage businesses, our innovators, because that is where so much of the new thinking, the new ideas are germinated, and the government, U.S. government understands that, policymakers understand that, Congress understands that. These are typically bipartisan incentives and credits, and just to put that out there as well. All right, that is the walkthrough of workshopping on how a pre-tax, pre-revenue startup can increase their runway by 20% by the end of their 3rd year in business. I'm going to add a couple of esoteric, actually, let's stop there. Were there any questions, Rich? Are there anything? All right.
Oh, we do have a question.
Yeah,
Is R&D, this is from Steve, is R&D credit only available to industries that were listed on the slide or just examples?
Those were examples, Steve. June talked earlier about her company, and it's involved in, it's not really agriculture, it's more in distribution. However, it's app driven, and the numbers that June mentioned, 7,000 farms, it sounded, I believe she had 700,000 products. That's fairly complex, trying to manage all that. So using technology, the cloud, using apps, there's a lot of R&D in there, believe it or not, and that's a good example that answers your question, supports the idea that you can find R&D in many businesses today unexpectedly.
And then his kind of follow-up question, are W-2 wages a requirement for the tax credits, R&D tax credits?
They are not, but to get the payroll tax offset, that's that pre-tax, pre-revenue startup. They're needing to have payroll tax liability, FICA liability. You probably know that there's withholding FICA, which the employee pays. The employer also pays a matching amount, the 6.2%. That amount is what's paid. So it's not income tax, it's payroll tax. But by virtue of having W-2 employees, because part of the policy here is good jobs, providing good jobs, and that is one of the reasons why innovators, startup companies, entrepreneurs are deemed to be bankable with these incentives and credits by the U.S. government.
And then I have can you carry forward tax credit towards future payroll tax liability?
Yes. Once it has its designation, this is an election that you make. It's a fairly complex process you go through to do all of these things. But once you've done that, and if you do not consume it all in that year, you can carry it forward 20 years. And so in a growing startup, chances are that's going to be consumed very rapidly. And so you're really not going to be looking at much. I rarely see much of a carry forward, more than maybe a couple of quarters for the kind of companies that typically are using the payroll tax offset.
Okay. I have a friend who has a pre-packaging food company, and he spent a lot of time like developing e-commerce, the automation. He had to get things. He had to get the food like shrink wrapped or wrapped and then flash frozen. Is that considered R&D or is that just business?
It is R&D, and that's a really good example of the process type of R&D. You're doing some development of product, but it's process mostly there. You're talking about web-based, just-in-time kind of things, so you're not carrying too much inventory. There's some management technique there you're looking at, but really it's how do you execute? How do you do it? Mm-hmm. And it's through apps, software, a platform. It's through equipment, machinery, programming it, getting the right materials, getting the right kinds of things that are going to preserve packaging of different things. Packaging has effects on different products depending on what the materials are. That's all R&D. There's some process and some product R&D there, but packaging companies do a lot of R&D, and that's something that surprises people.
All right, that's great.
Okay, so all right, then to get into a couple of more esoteric areas, and I'll go through these really quickly because these are going to be very specialized, but nonetheless, they are the three things I'm going to talk about next briefly. All are available to a pre-tax and a pre-revenue company. And to remind you, pre-tax means you might have some sales, but you've got a lot of losses, NOL, because you're a startup. And so you're not paying tax even though you've got some sales, you've got some revenue. Pre-revenue, that truly is the startup that is still developing its go-to-market, its product, process, and such. And so those are even earlier stage, but all five of these we talked about today are available to any one of those types of companies. Right. The first one we'll talk about briefly, this is the Renewable Energy Investment Tax Credit. This is new. with the Inflation Recovery Act last year, 2022. If you have a facility and you're going to be retrofitting it, and this could be leased property, leased premises. So your startup, you're now year 3, year 4. So just to take the chronology, the timeline of the slides we just looked at, let's say now you're in year 4 and you're needing to build out a facility to do your development. You've got a bigger payroll, you've gotten more investment, and now you're going to spend some money. And so you might now be looking at retrofitting or building out new property, new premises, manufacturing facility, R&D facilities. You might be now looking at, well, we want to have solar on our roof because we want to have energy security. We need to make sure that we're not going to have any downtime. This is very important for drones. We've got to have a consistent source of power. If the grid fails, we need to have our own microgrid, for instance. And that is not a far-fetched thing at all today. As a matter of fact, these new Recovery Act laws, Inflation Recovery Act statute is taking us that direction, to this idea of distributed generation of energy for energy security, among other things. And so if you're if you have a chain of grocery stores, you've got to have energy security. You've got to be sure independence. You've got to make sure the grid fails. And we've all experienced that, whether it's through storm, whether it's through conditions that are beyond our control. If you've got your own energy power plant, you are going to have more energy security than you otherwise would have. And that's accomplishable today through having these features built in to your facilities: solar, wind, geothermal, heat pumps, microgrids that I just mentioned. Microgrids, interconnectivity, and batteries. These are not far-fetched at all, and they're not as expensive as they once were. And the new thing about those are all covered by this investment tax credit for energy, renewable energy. You can get up to 50% of your qualified spend back. That's astounding. And that depends on a few other criteria. But the base credit is anywhere from 6 to 30%. And by doing that, you're able to get these renewable and sustainable energy supply sources built into your facility, and it's going to be subsidized through the tax code once again. And so this is new for startups and early stage businesses. They couldn't really do this before. The reason for that is, again, they couldn't monetize it. And that's what we're all about here today. It's how to extend Runway. Doesn't mean you're going to do something that's going to put a tax benefit on in your financials or as a carry forward on your tax return. You're actually going to be doing something that's monetizable. And here's what happened in this Recovery Act from last year. These investment tax credits for renewable energy are now transferable, meaning you can raise you can generate $500,000 in ITC. And that doesn't take a lot. That's maybe 1.2 million in spend, 1 million in spend, 1.2 million in spend. You're generating a large credit, but you're probably not going to use it for many years. You can now sell that credit. There's a marketplace that is going to be able to take those, value them, and purchase them. So that's really important if you're involved in any of these industries where you need energy security. Drones, for instance, you've got to have a consistent, solid, dependable backup, because imagine the chaos if you had uncontrolled drones flying around. And this is not just for the R&D stage, but this is in the deployment stage. These are things that we're doing a lot here in Northern California and Nevada. And so this is, again, very real example.
I'm just looking at would having an own electric generator, does that count?
It depends how that generator is fueled. A micro turbine is typically is just what you're asking about. That is it's the old diesel generator, right? That's what we're all familiar with. This is taking us out of that into a much more efficient and sustainable and less greenhouse gas. And so a microturbine is typically gas generated. And so it's more efficient. It's less detrimental to the environment. Now microturbines are being developed. And so this is if you're doing something like developing microturbines that are solar powered, for instance, or wind powered, or that could be combined with a battery solution. Now you're really doing some incredible things because you're taking that to the next level. And these did not exist as opportunities in this way prior to last year, and they're effective 23. So it's taking the idea of a generator, a diesel generator, bringing it into the 21st century and being able to subsidize it up to 50%, anywhere from 6 to 50%.
Yeah, makes sense.
Yep. All right. So, and then in addition to Rich's comment, this actually dovetails in. So if you're in that space of developing microturbines, let's say that you are developing microturbines, you're a third, fourth year startup. Hello? You're a third or fourth year startup and you're developing microturbines. You need to expand your plant to do your R&D and your manufacturing of these products. There's a different energy ITC, investment tax credit, for that capital expansion of that manufacturing plant. So to carry that example, you're now going to get up to a 30% ITC for that expansion as well. And it's also transferable, as I said, where you'll be able to identify if you have a $500,000 ITC that you cannot use because you do not have tax appetite or tax liability, no matter. You'll have a free market to be able to sell that in. Typically, you'll get 70 to 85% on the dollar, depending on the quality of the credit, the amount of credit, things like that. So one last one, somewhat related. This is a cousin of the advanced energy project. You're making the microturbines, for instance, developing those. Now you're in the semiconductor space. Here where we are, this is a very natural pursuit for a lot of startup companies in some capacity, being involved in the semiconductor industry. So if a company is expanding or building or expanding a fab or a foundry or a plant to manufacture equipment used to make semiconductors, there's a 25% investment tax credit available for that. This is typically a much more scaled thing. This is something that the Microns and the Intels of the world are doing. They're adding fab plants and taking advantage of these very substantial ITCs. The question remains, though, how far down the supply chain will this go? What if you're providing some element or aspect, or if you're an outsourced fab or foundry and you're expanding your plant? I would believe that would be the type of a company that could qualify for this. I'm working with clients now that are startups. There's in Southern California that is making a very specialized wafer. They're not going to need a full-scale plant for what they're doing. And so this is essentially a startup that can qualify for this advanced manufacturing investment tax credit. And again, now this one is a little bit different than the energy ITCs, investment tax credits. This is one that the company itself can elect to treat it as a tax payment. So here we are, a pre-tax company with an NOL or a pre-revenue company that's been funded, has this investment tax credit. They might have a $250,000 tax credit. they can claim it on their tax return even though they pay no tax, and they get a tax refund. This is called a refundable credit. And this is, again, monetizable tax incentive and credit available to a startup or an early stage company. And so the key takeaways at this point are contrary to belief, and I'll go back to slide 1. Contrary to belief, if you are a pre-tax or a pre-revenue startup, there are substantial federal tax benefits, incentives, and credits available to you to help you sustain and expand your capital. And so that is what I've got today to present. And it's mostly awareness, education, and the idea that these benefits do exist. And if you have any questions today, happy to take those questions. If there are any questions you have that come after, again, I'm happy to entertain anything that may come up. And I appreciate the time in listening.
So let's stop sharing and then we'll go to the video. So hit stop. We'll go to the screen. There we go. Okay, is there, you guys have any questions? You can either raise your hand or you can just unmute yourself and ask a question. So I want to just go with that one example you did. So you're pre-revenue, you're paying taxes. I mean, you're pre-revenue, you have wages, and I think it was your second example. And so using the tax credit, you actually get, even though you haven't paid any taxes, you would actually get a refund from the IRS. Is that how that works?
Yes, and here's how that works. You're not paying income tax because you're not, you have losses at this point. But if you have W-2 employees, you are paying payroll tax, FICA, which is different than income tax. Your income tax return will show your losses. You report your R&D credit there, for instance, and it's your payroll taxes that you file quarterly. That's a different form, and that's a different type of, that's a trust fund payment. That's something that you work with a payroll company, and they do that for you, or you do it with your accounting department, separate and apart from income tax. That is the payroll, that is the tax liability that all companies with W-2 employees have. And so that is that's what you claim those types of credits against.
Okay. So I have and I actually know a lot of startups. And so I'm planning to send this recording to them, but let's say they didn't, the example I gave you, he did all the work, but he didn't take an R&D credit. Is this something you can go back, have an account, or you maybe go file for, is that something you can follow in the past tense?
We do. We're able to go back all the way to the beginning. It's harder because documents disappear, people move on. It's harder to do, but we can certainly go back to the beginning in most cases. The problem is there, how do you quantify it? If the doctor had engaged people who help him, assist him, even though they're not W-2, they might have been contractors, and he would have been paying them something. He might have been consuming materials if he was doing prototyping. If it was in dental industry, there'll be a lot of prototyping with expensive materials, things like that. That's possible. It's going to be a small credit though, until it reaches that critical mass point, because it's really going to be about 10% of the qualified spend, more or less. That's just with the federal benefits we're talking about today. And that's a rule of thumb. That's not the exact number.
So the other startup that I work with, it's the food delivery, and they invested, basically a little bit in automation.
Yeah.
Can they go back?
If they've been paying contractors, US based, and they've had W-2 employees involved in the R&D, and they've been sustaining cloud costs that they've been using to develop their platform.
What about the machinery costs?
Machinery costs, it's not the capital cost, it's the setting up, the calibrating, the labor. Yes.
Okay. So what's the best way? I mean, is this something, this is probably more of a plug for you now. Is there should they see they're a tax person, or is it something very specialized and they should probably see you?
It's something that I would, at the very least, talk to your tax person, because these are things that you're gonna maybe get some feedback on. We work with over 8,000 CPAs all over the country, and the reason we do is because CPAs are so busy just trying to keep up with the tax law changes and getting things filed on time and gathering. And we're essentially the backbone for many CPA firms in the country. And that's our role, is we work with CPAs. And so glad to have them get in touch with us. Or you can contact me directly. Either way is fine. The important thing is the word gets out, and startups are seeing these real opportunities and hearing the word tax and thinking, well, that has nothing to do with me. That's we're past that. That's not where we are today.
Okay, and I'm just doing good feedback. This is from Diana Eastman. This is most informative. Thank you for your time. So that's from Diana.
Well, thank you, and I enjoyed sharing and pass the word along to your colleagues and friends and business associates.
Okay, it looks like there are no questions, so we're going to go ahead and sign off.